Welcome to ETH Daily, a daily briefing on the latest in Ethereum. Here's your latest for Monday, August 10th, 2026. Instead of a flash briefing today, I'm going to cover the Tapered Issuance Burn Proposal. The Issuance Burn Proposal, also known as EAP 8363, has taken over the timeline in the past week. Introduced on August 4th, 2026, the Issuance Burn seeks to burn validator consensus layer rewards along a new issuance curve that hits 0% once 50% of all ETH is staked. The issuance just means new ETH that gets minted as part of validator rewards, since Ethereum is currently inflationary due to this, and Ethereum has always been inflationary. Before proof of stake, Ethereum was on proof of work and issued new tokens to reward miners. The issuance change is an economic change, not a technical one, but it's been a confusing discussion. This is not a technical explainer with all the details, but rather it's just my understanding of the proposal. So a quick TLDR is that the status quo, meaning the current issuance curve on Ethereum, the current issuance curve has an issuance floor of 1.5% APY. This means that even if 100% of all ETH is staked, the base reward is 1.5% APY from issuance. And because of this, the staked ETH supply is expected to continue to grow. Under EAP 8363, also known as the Issuance Burn, the staked ETH supply will not grow past 50% because issuance will be 0% at that level, and there will be no incentive to stake, since after that level, stakers will essentially incur losses. The difference between the status quo and EAP 8363 is that the new proposal compresses the range at which staking becomes unprofitable from 70 to 100 million ETH down to about 50 to 60 million ETH. My take on this is that EAP 8363 is an attempt to solve a real problem. However, the costs outweigh the benefits in its current form. So now I'm going to dive into the proposal. So what does it do? The Tapered Issuance Burn reduces issuance by burning a portion of validator rewards. It will burn base rewards along a tapered curve that reaches a 100% burn, or 0% issuance, when the staked supply hits 50%. The change would be imposed across an 18-month transition period. The proposal essentially disincentivizes the staked ETH supply from surpassing 50%, helping to maintain a more balanced stake ratio so that the network doesn't have a high percentage of ETH staked. So why is this proposal being proposed? It was proposed for inclusion in the Ethereum Hegota upgrade. So the stated goal of EAP 8363 is to strengthen credible neutrality and resistance to capture. I believe this is a valid goal for the proposal. The current issuance curve, which has a floor of 1.5% APY, even if 100% of all ETH is staked, it incentivizes everyone to continue staking ETH. And as everyone stakes more ETH, stake tends to concentrate with larger operators, custodians, and liquid staking protocols. And of course, that's an issue because you don't want the staked ETH supply to be in the hands of a few large operators. Now I'm going to go over the proposal arguments. I'm paraphrasing them here. The first argument is that some entities will become too big to fail. If a large operator gets slashed or exploited, it can be too big to fail, and the network will have a moral duty to compensate its users through a hard fork. The second argument is a weakened social slashing, so large operators could either form a coalition or work together to avoid social slashing events, and the social layer becomes less able to coordinate hard forks or less able to put a penalty on large operators for misbehaving. The third argument is dilution. As more ETH is issued or minted, The total supply of ETH increases and everyone's real yield gets diluted when you account for that inflation. The proposal argues that solo stakers are particularly hit and says that ETH holders are overpaying for security via dilution. The fourth argument is forced staking. An increasing ETH supply forces non-staking ETH holders or regular raw ETH holders to stake or risk dilution. It results in less ETH being used as money in the open market. The fifth argument is that LSTs replace ETH. As more ETH is staked, LSTs, or liquid staking tokens, become the default asset across DeFi. It results in a systemic risk from increased smart contract governance and issuer risks. And the sixth argument in the proposal is dependency. The applications and protocols issuing the derivative assets acquire outsized political and economic leverage over the Ethereum network. Now I'm going to go into my personal understanding and thoughts on some of the issues with the proposal. While it has valid reasons and valid problems that it needs to solve, these are some issues that I see with it. So the end outcome in both scenarios, both status quo and the issuance burn, are bad outcomes. And the final state, right, of both outcomes, first is in the current issuance curve. If everyone stakes on the network, essentially you have to stake to not get diluted, and the rewards are essentially zero when you account for dilution. Issuance burn is framed as less bad than the status quo because it reduces the range of ETH staked where solo stakers, institutions, and LSTs become unprofitable. However, they both result in the final outcome where large staking entities have an edge, and generally they are the last ones to be impacted by a negative real yield. The resistance to capture problem still exists under both scenarios. The solo staker will be the first one to reach negative real yield. Professional staking operators will always have the advantage of economies of scale with lower fixed costs, greater MEV opportunities, better uptime, volume discounts, and so on. MaxiB, which was a feature introduced in the Pectra upgrade, reduced operational overhead further for large operators by allowing them to consolidate their validators. The core of this debate comes down to what is the impact and what is the difference of the impact of ETH staking becoming unprofitable at the 70 to 100 million staked ETH level, which is the status quo, versus the 50 to 60 million staked ETH level, which is the issuance burn. Changing ETH issuance kind of has an impact on the broader market. So the ETH-based staking yield from issuance itself, it drives demand for ETH, incentivizing everyone from digital asset treasury firms, institutions, ETFs, liquid staking protocols, and individual holders to buy and stake ETH to earn yield. Staked ETH reduces the circulating supply of ETH and eases sell pressure on the asset, but reducing issuance will have the opposite effect. With lower yield, validators that are currently profitable will become unprofitable sooner and will have to exit. As mentioned above, solo stakers will be among the first stakers to be hit by negative real yield. There's also a ton of staking-based businesses built on Ethereum. They've purchased ETH, they participate in network validation, they provide real services. A reduction in yield cuts into their margins, and we'll see some businesses shut down and unstake their ETH. That also puts significant sell pressure on ETH. There's real teams building on Ethereum, staking such as DVT infrastructure like Obol and public goods funding mechanisms like Octant, which uses the yield from staked ETH to support public goods projects. And the entire Ethereum DeFi ecosystem kind of uses the base staking yield rate as a basis. A sudden reduction in ETH staking yield directly reduces lending and borrowing rates for ETH across all DeFi markets. Today, most users borrow ETH to stake it, lend ETH for yield, and use ETH as collateral to borrow stablecoins and buy more ETH, commonly known as looping. However, when you reduce the staking yield, it'll reverse those incentives. Market participants will borrow ETH to sell it. They'll stop lending ETH due to low yield, and they'll use stablecoins as collateral instead of ETH. It will trigger a unwinding event of staking yield strategies. DeFi vaults will see outflows, DeFi TVL will decline, and overall demand for ETH will also decline. And not all DeFi users are yield farmers. There's real users from around the world that rely on DeFi for savings, investment, and hedging against their local currency. So the impact from such a change can have far-reaching consequences. The concern itself is not about the yield, but more so about the disruption from the sudden change of the yield and what impact that disruption will have on the market. I mean, long term, maybe things will settle down, but in the short to medium term, this type of disruption will cause liquidations. It could cause businesses to shut down, users to leave DeFi, and so on. And one reason why this EAP is controversial is that it's based on projections. It's not known what the market equilibrium will be in the future under either curve. And one of the arguments for this proposal is that it will help the market find equilibrium above 0% issuance under the new proposal. However, these kind of figures for market equilibrium under both scenarios are based off projections, which are based off cost estimates. And if costs turn out to be higher than estimated, it kind of changes the figures for these estimated equilibrium points. So in the longer term, Ethereum kind of has a target validator figure of 128,000 validators. Right now, Ethereum has around 900,000 validators on the network, and the goal is to reduce that down to a target of 128,000 validators. And Ethereum has kind of a series of changes on the roadmap to help reduce this figure. One of those changes was MaxEB, which enabled validator consolidation. And the purpose of this is because a smaller validator set reduces the signature attestation and state load on the network. And these long-term series of improvements helps get Ethereum closer to single slot finality. However, it's not clear whether the issuance burn proposal has an indirect goal to reduce the validator set. Now, it will help disincentivize new validators from joining the network and kind of put a soft cap on the number of validators. So it essentially caps the number of validators and aligns with having a smaller validator set, but it's not clear if this is the intended purpose of the proposal. And in conclusion, I think the goal of balancing the stake ratio is good, right? You don't want to have a huge portion of the ETH supply staked. I think that this proposal, EAP 8363, it mitigates but doesn't solve the stated goals. And I think, overall in its current form, the costs and potential impact from the proposal outweighs its benefits. So if you have any feedback or comments on the proposal, feel free to share them. Follow at ETH Daily on X. You can find our post there. In other news from today, Vitalik published an Ethereum straw map overlay of the 2023 Ethereum roadmap. ETH Labs released its Week 7 update and announced that it is having 2 new hires join the organization. It also outlined its take on EAP 8363. If you want to take a look, it's linked down below. Base Chain turned 3 this weekend and introduced the Builder Grants program. Fake world assets generated more 24-hour revenue than Ethereum over the weekend. Hero News Weekly number 34 is out, and DeFi Saver introduced liquidation protection. This has been a summary of today's top news stories in Ethereum. If you enjoy this podcast, please subscribe and follow us at ETH Daily, and subscribe to the newsletter at ethdaily.io.